Hey, what's going on, guys? Zak Klinedinst with eXp Realty. Hope you guys are all doing well. So for all of my Florida homeowners, I have a big treat for you guys today. I have Greg Cohen, certified board real estate attorney, with me here today. And what we're going to do is we're going to share some information with you in regards to the tax portability. If you guys have never heard of the tax portability, this is a way for you as a homeowner to possibly save thousands of dollars on your taxes every year moving forward when you are going to transition from your current home, your current homestead, to a new homestead. And there's a lot of questions around this. A lot of people don't know or understand how the homestead and the tax portability work. So I brought in Greg today. He's a phenomenal attorney who's going to answer all of our questions. And if we need to get access to Greg afterwards, you guys can reach out to me directly and I'll connect you guys with Greg because he's going to go over a lot of details today that you might not have known about and you might still have questions on after the interview. So I'm going to introduce Greg and we'll get into some questions here. And that way you guys can just kind of get the nuts and bolts of the tax portability and go from there. So Greg, thank you for being here today.
Thanks for having me.
You're welcome, Greg. You're welcome. So Greg, tax portability, first question is, who can qualify for tax portability? Who is it for?
Well, tax portability starts with a Florida resident who qualifies for a homestead exemption on their primary residence down here. So in essence, once somebody buys a piece of property and it is their primary residence, they fill out some paperwork and they file that with the property appraiser. And at that point, that property becomes their so-called homestead for tax purposes. Okay. Now, the question about homestead availability always is determined on January 1st of that particular year. So if you bought a piece of property on March 31st and you made that your primary residence and you filed for your homestead application, that property would not be registered as your homestead until the next January 1st.
So that's after March 31st.
It would be at any time after January 1st. You have to qualify for a homestead on that property. You have to actually own that property and have it as your primary residence on January 1st, which means to most people, they would have to close on December 31st.
Correct.
And move in, and then they could qualify. Now, there are possibilities where you can actually close on January 1st. That's a whole other thing. So if you bought a piece of property where in 2000, you're closing today or tomorrow, and I'm not even sure what day today is,
Today is April 25th. Today.
April 25th. So you bought a piece of property and you closed on it today and you moved into it as a Florida resident. That person would then go file for homestead. However, the homestead on that property for that buyer would not be applicable until January 1st, 2025. So that would be the first year where it kicks in. Okay. However, if the person you're buying the property from had it as their homestead on January 1st, then it would continue through that year. So you still would have a lower tax basis that year.
Understood. Okay, that makes sense. So okay, we got the homeowner who owns a home, that's their homestead. Let's say the person watching the video, they're already in the property, they own it, it's their homestead. Who would qualify for the tax portability? Like, how could we save this person money? Is it for they got to sell their house, right?
Correct.
So for tax portability purposes, and who qualifies for it? Is it a homeowner, home seller?
Well, it's not necessarily anybody who just sells their house. You can actually, if you own two houses, you could move it. But traditionally, it's people who sell their house.
Okay.
So let's say and again, it all depends on the benefits that you've received from the homestead cap since you've bought the piece of property. So, and that might be a little confusing for everybody.
So let's say I bought a house for $300,000 3 years ago.
Okay.
So I bought a house for $300,000 3 years ago, and today it's worth $500,000.
Okay.
Hypothetically speaking. So because I'm buying a higher end home, does that mean that I qualify for tax portability?
Yes, you would if you did buy a higher end home, and you also qualify if you bought a less expensive home. But it's a fraction of your portability. See, portability always arises under the difference between what your market value is on your property. Okay, like the day you bought your property at 300,
correct.
The market value would be, you'd think it was 300,000.
Back then, 3 years ago.
Correct.
Okay, yep.
And then the next year, and your assessed value, now generally the property appraiser uses 85%, but not being a mathematician, why don't we just say the day you buy it, your property has a market value of $300,000, and the property appraiser would tax you your assessed value on $300,000, an easy formula. So what happens the next year? Well, let's say every house on your street started selling for $400,000. If you were locked in with Homestead, the market value on your house could go up to $400,000, but the assessed value could only go up 3% or a CPI, but generally it's 3%. So at that point, the next year, every house is selling for $400,000. The market value would be $400,000, and your property would only be assessed at $309,000.
Okay, yep.
And the difference between those two amounts, what the market value is and the assessed value, that's your portability.
So that means I would have $91,000 in portability if I sold my house that following year.
Correct. And you bought a house that was equal or greater than the market value of the house you were selling.
But if I bought a house less expensive, there probably wouldn't be any kind of benefit for tax portability.
There would be a benefit. It would just be proportionate. So if you bought a house that was half the value of the house you're selling,
Gotcha. Okay.
you would get 50% of the $91,000.
Okay. Now, okay, so I bought a house for $300,000. I'm assessed at $309,000 because of the 1 year later, it went up 3% as the max, as a cap. But now my house is worth $400,000, so there's a $91,000 portability that I can now use. If I go buy a house for $600,000, I can only reduce that $600,000 by $91,000 for my tax portability.
Correct.
Is that how that works?
That's how it would work in that situation. And just to, like we referenced, with the first time when you bought the house at $300,000, the market value and the assessed value. Correct. Now you buy a house at $600,000. Your market value you'd think would be $600,000, but the assessed value automatically right up front, you take off the $91,000. It'd be $509,000.
Gotcha. Okay, so it'd be $509,000. So that's that's a pretty big savings for people, right?
Correct. For every $100,000, you're looking at approximately $2,000 worth of taxes.
Okay.
Multiply that over, extended
Of course.
term. Correct.
So so what if I've been in my house for 10 years? Let's say I have a house I bought for $300,000 10 years ago. Now it's worth, what, $1 million today?
Like every house here.
Like
Yes.
every house here in South Florida? Yeah, exactly. Like the average house nowadays,
Right.
it seems like. So is there a cap on that? Because now we're looking at 300 times, at 3% for 10 years, it went up, what, 30%?
Right.
So I'd be now assessed from 300,000. I would have went up to, what, 390?
It's something like that. I'm not.
I'm just doing the math in my head. So it'd be 390, let's just say. And I hope I'm not confusing you guys, but again, if I'm confusing anybody, that's why we're going to be here afterwards for a phone conversation. So 300,000, now I'm assessed at 390 10 years later, but I'm buying a house for $1 million.
Okay.
Right?
Yes.
So there's basically a $600,000 difference there, or $590,000 difference there.
Correct.
Can I use all that difference?
You can use up to $500,000. So basically, you still get your benefit of being a Florida resident all those years, and you'd get the benefit to take that $500,000 is the maximum portability you could move over. So when you have that house that you bought for $300,000, and now it is worth $1 million, and now you've been there for 10 years, you have higher income, and you want to move to a better property, more expensive that you can afford, you will still get that same benefit of $500,000 of tax savings if you bought a house equal to or greater than the market value of your house, being $1 million in that example.
Okay. Wow. That's crazy.
And you take that savings, $500,000, using a 2% formula, roughly $10,000 a year of taxes. But the key is most sellers in Florida, part of the reservations of moving to a new house deal with taxes. They feel that they've earned those savings, and they have earned it through our Constitution and the limits on their tax increases. Mm-hmm. So when they do buy that house, more money or even less money, they do get that benefit. You don't get the full benefit if you wanted to downsize Well, yes, you still get that benefit. If you bought a property at 500,000 and yours was worth $1 million, they would still get $5,000 worth of savings. It's a very good vehicle for allowing sellers to move to another property and not lose what they had built up in equity and tax assessed protection.
Well, dude, especially when you have people that are on a fixed income, they have, one income or two incomes coming in, but they're still fixed. I mean, $5,000, like anything will help if you could save money on taxes. Anything helps.
If you did not have portability available, it would be an interesting figure to know how many people would not sell their house because they just couldn't afford it.
Okay, so I have a question. I've sold a lot of homes, but my question is, I have a lot of people who don't even realize when I bring up the fact of tax portability to them, they never even heard of it. So what's the percentage you think of actual homeowners who sell their home to buy a bigger home and actually take advantage of this tax portability? I feel like there's so many people who don't do it and so many agents who don't even know how this works.
Well, a lot of times people will learn about it when they finally have closed on the house and when they go file for homestead. The property appraiser may ask you. But the hiccup is overcoming the impediment, the fear. I don't want to sell my house. If you don't want to sell your house, you want to sell your house, that's their decision.
Of course.
But if you're not doing it because you're not aware of the facts, that's the problem. That's where people should get more educated. You educate your clients about it. That's what we do. People call me, first thing they say, I can't move into a new house because I'll pay more in taxes.
Yep.
And I say, well, do you have portability available? What is that?
Correct.
Well, basically, yes, you might buy a more expensive house if you're going from a $1 million house to a $2 million house. That's more taxes. But in your example, you're paying more because it's more value, but you'll take $10,000 off every year.
Right.
And then all of a sudden, then they can start calculating what they should be buying, and it gets people off the fence and it helps them make their decision. If you're going to move into a house and you knew that you had to pay $10,000 more every year based on your budget, you would lose a lot of people.
Of course.
But they may not know that house, they don't have to pay that. And you take $10,000 off, and that's what we all do. We educate people about it. So once they know, they can make that informed decision, and they're dealing with a realistic budget as opposed to the budget that they think they're going to have without portability being available.
Yeah, that's huge because I talk to so many people that they don't. That's the first thing I get because I advertise very heavily on different platforms and we get buyer leads that come in and sometimes they have to sell a house in order to buy the next one. But their biggest hang up is like, oh my gosh, my taxes are going to go up to like 1.8% of the purchase price. So on an $800,000 house, you're talking like almost $15,000, right?
Correct.
If you're buying a house for $800,000, your taxes will be close to what, 15 grand?
15, 16, right.
Give or take. So they're going from a $6,000 a year tax bracket to now $15,000 a year. That's a big difference for those people.
Correct.
So, and then you just mentioned about tax portability. Hey, have you ever heard of this? They say no. So that's where I think this education, this video could be very helpful for people out there because they don't even know they have access to this. So I think I really appreciate you doing this today. And so we have what it is and who qualifies for it. I guess, what are some other details you could share with us in regards to tax? Like is there a deadline? Like if I buy a house in June, like, is there a deadline that you have to apply your portability? Like, how does that work what's the process to even?
I mean, it's only the most complicated
right.
deadline. Basically, when you remove your homestead through a sale, or like I said, if you have two houses, you can do it. Whatever date that you did that when you removed the homestead on, you go back to January 1st, provided it was your homestead that whole year. You go back to January 1st, and you have 3 years from that January 1st to qualify with a new homestead.
So you have 3 years, okay.
So if you sold your house April, 24th, whatever today is, and we go back to January 1st, 2024, 3 years, January 1st, 2027, you would have to own another house and qualify that as your homestead, which would mean most people you would have to close by December 31st. We have processes where you can't actually close on the 1st. It's just a a difficult thing, but you would shoot for December 31st, 2026 if you own that house and make it your homestead. And one thing that people is going to come up out of this, when you make it your homestead, that's a factual matter. I bought this house and we're moving in. Okay. You still have a few extra months to apply retroactively as long as it was your house December 31st.
Okay.
And you have until March 1st. We all hear about that deadline. I've got to file for homestead. Well, the only reason when you file on March 1st, you have to have owned the property and made it your homestead on January 1st.
Okay.
And I'm not sure if that makes sense to everybody, but that's the deadline for filing retroactively. But the key date is January 1st. So you would have 3 years from January 1st, 2024.
Okay. And at the end of the day, man, like I can, like the listener that's listening to this, it's a lot of information, right? Like it's a lot of stuff to go over. And so if the audience that's watching this video, they want to call us and talk to me about this, we'll do more of a formal education for these folks, like a one-on-one. And I'll talk to the audience about that because they might have a lot of questions on this, because I think the big thing is that if you are selling your home and are moving up, if you're a first-time home seller and this is your first time selling a home, now you have to buy something bigger because the family's expanding, job relocation, whatever the case is, you have to buy a bigger home. So you could save thousands of dollars per year on your taxes by taking advantage of the tax portability. So if you have questions on this, you guys can give me a call directly and I'll go over this with you in more detail over the phone. And if you want to connect with Greg, I can then also connect you with Greg and we can go over those details as well. But Greg, is there any other important information on the tax portability that you could share with the audience or any key points before we end this here?
Well, I think one of the key factors that's been arising over the last 2 or 3 years is challenging the property appraiser on your taxes. And when everybody hears that, you get that tax bill and you go into the property appraiser and generally you think, Mr. Property Appraiser or Mrs. Property Appraiser, you assessed us too high. My property is really worth this value. And you try to lower it so you have lower taxes. The hiccup is that the person that you mentioned that lived in their house for 10 years, their house, when they bought it at $300,000 and it goes up 3% a year, and then you're 7 years later, they're assessing that property at $500,000. And in that example, or 10 years later, we'll use 10 years later, you had $110,000 worth of portability. What we've seen is that the property appraiser doesn't always revisit those properties because the homeowner's already locked in.
Right.
So it doesn't make a difference if the market value goes up. So what's happened is that same house that was worth $500,000 after 10 years is now worth $700,000 after 15 years. But the property appraiser may not have raised your market value of $500,000 to equal the value of the other houses on the street. So the person in our example moved and they had $110,000 worth of portability. But really, the house they're selling wasn't worth $500,000. It's really worth $700,000. So what's happening now is a lot of people are reaching out to file tax appeals on their trim notices in August.
What's a trim notice? What's a trim notice?
Trim notice is the actual assessment that you'll receive from the property appraiser in August, what they say your market value is.
So every August, as a homeowner, we get the trim notice that says what our home is market value.
Correct.
Or is it assessed value?
I'm not sure if it says your assessed value on there.
Okay.
But it will definitely tell you, I haven't looked at it, but it will definitely tell you what you think the market value is.
Gotcha, okay.
But what and the property appraiser is very accurate. They use a lot of numbers. I mean, again, they're not out there to,
They don't try to hurt you or
right.
anything,
They're right. But what happens is if you have a house that was worth $500,000 after 10 years, and after 15 years, it's $700,000. The property appraiser may not have focused on your house
Correct.
to increase your market value. So what we've been doing is you actually appear before the property appraiser and say, look, this house is not worth $500,000. It's actually worth $700,000. And here's the data to show every house on the street, is the same, and they're all selling at 700,000. These are good comps.
Right.
Now, if you're listening, you're rolling your eyes at first. You're saying, why are we trying to increase the value? My taxes,
That's what I'm thinking.
My taxes will go up.
That's what I was thinking. That's why I wanted to ask you.
Your taxes will only go up the same 3%. So you're still capped with the increase. But what happens is, because your assessed value only goes up 3%, the market value goes higher to 700. So now you have more portability when you go buy your next house.
Because it's always market value compared to assessed value of your current home.
Correct.
So your current home, if you're 300,000 purchase price, 400,000 purchase price, and it's 3 years later, it went up to a market value of 600,000, but you're only assessed now at, let's just say, 420, whatever that number is. So there's that $200,000 gap, let's just say it is, the portability that you have because of the current home that you have, that you live in, your current homestead.
Correct.
So it's all based off the current homestead, market value versus assessed value.
Right. And the only thing is that when you live in a property so long and you're still protected, the property appraiser may not be focusing on the actual market value. Because if I said to you, look, you've got $200,000 worth of
because they don't care about it, because they don't get their tax money off of your market value. They get it off of the assessed value.
It's probably in the back of their minds that no matter what they do to change that property,
It's capped.
It's capped. So the taxes will not go up. So let's focus. We've also had a lot of people moving here. I'm not going to throw them under the bus entirely, but
Of course.
they're going to focus on the ones where it really matters. So what ends up happening when you go in and appeal, and if you did prevail, let's say you had $200,000 of portability, you bought your house at $300,000, and that's your assessed value, and the market value is $500. That's $200,000 in portability. But now every house is selling for $700,000. If you went in and appealed, now that $500,000 and you prevailed goes up to $700,000. So now you take $400,000 of portability. So in essence,
That's huge.
$200,000, roughly $4,000 or $5,000 worth of taxes to your next house every single year. And that's been the process that's starting to unravel a little bit with these value adjustment board hearings, which we're getting more and more involved in. And it's for people that haven't looked at their taxes because they always were capped. But when you start preparing in advance, understanding portability, no matter what it is, your savings, and then you also can take into account preparing for a future sale down the road so you get the maximum amount available. That is when you're going to have a better, a more informative seller and a better off buyer, because when they're locked in, it's like buying a house with a better interest rate. Mm-hmm. Would you rather buy the same house with 7% or 6.8%? If you could save $5,000 a year,
It's $5,000 a year.
Every year.
So that's huge. So if I'm talking to the audience and they want to sell their house, they're thinking about selling their house in 6 months from now, and they're buying a bigger house. Can they contact you or anybody to basically do this appeal? Because wouldn't it benefit them to appeal this, get a higher market value, so that way when they buy their next house, they have a higher portability deduction on their new homestead? So if they want to do this, how long does that process take to appeal to get a higher market value?
And I'm not positive how long it'll take to get, because there are rules on appealing. You first apply to the value adjustment board and you send that in, I believe, by the middle of September, and then you'll receive a hearing date.
Okay.
So, and whatever that hearing date is, between 2 and 4 months, before. But again, and there are some limitations. You can't file. We've had situations where a seller wants to file portability on a house they sold, and it doesn't work, that you cannot file for a reduction if you are not the owner of the property. So the point is, you have to be proactive. All I'd say is you can go online, there's a portability calculator, and start, you can try to figure it out yourself. call you. You can figure it out with them.
Yep.
I mean, the key to buying a new house isn't just looking at the purchase price of the house. I mean, anybody in the world can say, I'm buying that house for X dollars. I can afford it. It's figuring out when you have a mortgage, you have interest, insurance, taxes, and you gather all this information in advance. And it's a fun process because the numbers can only be better. When you take portability, your buyer, the numbers that seller, when they buy, it will only be better for them. So be prepared, look at it in advance, reach out, and start preparing for it.
Guys, that's the key word there is that he said about being proactive with this, because if you go to list your house tomorrow and we sell the house in a day or two, let's just say you close in a month. If that house is already sold, they can no longer take advantage of this tax portability. It has to be during the process so we know what we're working with in regards to that current homesteaded property.
Correct.
Homestead property, correct?
Yes.
So if they sold that house a month ago, let's say you sold your house a month ago and they did not do this tax portability, they cannot go back and do this now, correct?
Correct. They could not go back.
So they're done.
For the
They're
increase. Done. They could only take what they have on the books right then. But that's why you need to figure it out where you are in this process, because August is coming up pretty quickly.
So this is where having an educated agent, so I'll do a quick little shout out to myself here. So this is where having a proactive agent that has resources available like you to take advantage of tax portability that you may not even realize that you have access to, because it's a proactive approach. So if I have a client that wants to call me, we can get together, do an evaluation on their property, determine how much, what is the current property appraiser saying their house is market value compared to their assessed value. We can determine if there is an appeal.
Correct.
Right? Because if every house around them is selling for $700,000, but the property appraiser is only saying it's worth $500,000, we could appeal that.
Correct.
So now we can potentially get you as a homeowner $200,000 or more, or less, give or take. Every situation will be different, but we can now do that and basically help you as a homeowner save thousands of dollars in taxes on your next purchase.
Correct.
Right? So if you guys are looking to have some kind of evaluation done like this to help you guys out, if you're thinking about selling your home anytime this year or next year, love to have a conversation with you guys. So Greg, was there anything else that you'd like to throw in here, or any other key points that we can go over, or is that everything?
I think, that's a good amount of...
I think we give them a lot of information.
Yes,
so we give a lot of information. So guys, again, my name is Zak Klinedinst with eXp Realty. This is Greg Cohen, board certified real estate attorney. He's a phenomenal attorney. If you guys have any questions, please give me a call, 561-837-0032. Look forward to talking to you soon. Thanks.